We're gonna wait like a minute, we're gonna wait a little minute here just to make sure that the other members of the boot camp could try to come through. So we'll do that. But at 5:02 we start. And because you three are here, you guys have priority on all the questions, on all the optics that you want to apply, look at. So that's some cool stuff as well. We're going to go up to 8. If we finish earlier, we will. But I think we have quite a bit of things to look at. So it'll be dope. It'll be dope. All right, let's get this show on the road. So, really quickly, before we begin, just a quick little highlight. We have another session on Tuesday. We have another session on Thursday. Then we have a session on Saturday and Sunday. All right, so there's 4 more sessions. The next session will be the last theory chapter overlook. And then the next 3 sessions are going to be us going balls to the wall, going through final reviews, really looking at mock exams, being pushed really super hard, and really like sprinting towards the end goal. So that's the perspective. Now, quick spiel. I know this is recorded, but it's recorded for the group. It's not going to be monetized or anything, so it's like no worries. But if you want to, raise your voice or put your camera on, we are going to be doing 3 hours, and we're going to be doing this 5 more times. So there's 15 more hours ahead, or like at least 12. So, if you want to exchange, always down. And the session on Saturday may be in person if we could all like kind of convene towards that end. So something to look at. And yeah, so, quickly, did anybody, okay, so because we're going to be 4 for now, I guess, let me know, do we look at another question from chapter 10 just to make sure that we understand, or are we comfortable and we move on straight to chapter 12? What do y'all think? You can just write like yes or no in the chat type of thing. So do we do one last chapter 10 review? Okay. All right. What about Leandra, Amadou, Alexandra? Do you think we should look at a chapter 10 question today, or are we comfortable? Okay, so it seems like we agree that we should do that at the end. Unless Amadou, Alexandra, you want to raise your voice or some? We shall. Okay, cool. Bet. So let's jump into some chapter 12 stuff, the cool stuff. It's really easy stuff, to be honest with you. So I'm going to send something in a group like that. This is like the best comprehensive review thing that you can look at for chapter 12. So I'll send it to the group right now on Facebook. But I'm also going to be kind of like making sense of it as we discuss. So no worries on that end. But what I sent you in the group essentially is like a ratio sheet, like the master file that you need. It covers every single type of ratio category. And then it also looks at the explanation and interpretation that you may need to have there. So super cool stuff. We're going to kind of try to break through that together, make sense of it, look at the formulas, answer questions, try to make it funny. Also, another thing that I'd like to share, I'll put it in the group as well. It's this YouTube video that I made back in the days that covers financial ratios. It's pretty cool. It kind of tries to make sense of a few things. So I'll put it here in the chat as well as in the group. Because honestly, financial ratios, you just want to find what sticks, like what works for you. And what we're going to try to do today is we're going to try to not only like make you do some questions, but also figure out what sticks for you. and such that maybe tonight, tomorrow, or before Tuesday, you're able to kind of spend some time yourself uncovering the theory here. And really, like, these are 40 points, 20 points, let's say like 25 points on your exam that are free and easy to get. So we might as well kind of do it and figure it out. Okay. So let's make sense of the stuff, okay? So we're going to look at the first 4 buckets, first 4 types of ratios. Really quickly, is this big enough? Can everybody see? Are we comfortable with this? Quick yes in the chat.
Yes.
Does that make sense? Okay, cool. So let's try to make sense of what this big old quick ratio means. But before we do that, we're going to try to make sense of what a liquidity ratio is all about. Now, the formal, boring definition here is that it measures short-term ability of a company to pay its maturing obligations and meet unexpected needs of cash. Now, essentially what this means, just in like plain words, is that you're trying to see how liquid a company is. And being liquid really just means how quickly and how efficiently a company could make something into cash. Now, let me give you a really good example in terms of understanding what liquidity is all about. The reason why this is important is because this can be applied for Comp 17, your future classes, and real life, right? So we're going to look at 2 examples, and we're going to try to understand what is more liquid, okay? Let's look at cash, and let's look at this iPhone. Now, which one is the easiest to sell on the marketplace? Which one will you be able to 100% get somebody to get your cash or your phone? Which one will it be? What is the most liquid one? Just a quick little like brain tease here. Which one is the most liquid in your opinion? Okay, Daniela says cash. What else? We are 4 people that could participate. Nice, okay. So yeah, so cash, as much as it's something that we could use to buy stuff, it's also something that we could technically sell to others, right? I'm giving you $100 for $100, right? We know it's fair value. But a phone, if you sell it, well, you're going to have to wait a few days. You're going to have to put it on Kijiji, on Facebook Marketplace or Craigslist, and there's going to be people that are going to lowball you by like $600, and you're going to say, no, I don't want to do business with you. And then maybe a week later, somebody will come with that deal, okay? But now let's go back to our little comparison here. We had cash and we had a phone. The problem is, let's say you had an emergency to pay for. Let's say you lost 2 of your tires on your car. Obviously, you would be way more comfortable having cash because you'll know you'll be able to fix your car immediately. However, because your phone isn't liquid, because you can't translate your phone into cash immediately, you may not be able to repair your car immediately. You may have to wait a week, or in other words, you may have to wait for that perfect customer to buy your phone. So that's this idea of liquidity. Now, before we proceed, do we kind of understand the like vulgarized way I explained it about liquidity? Yes or no? Amazing, amazing. Okay, so that's really cool. Now, why are we looking at liquidity ratios and why do they matter? We look at liquidity ratios because we want to be able to understand to what extent is a company actually liquid. And in other words, to what extent are the assets of that company liquid? Okay, so what I like to do is I like to always look, and this is how we're going to do it. We're going to look at 2 types of examples. One at which we are a company. We're all going to be a company, us 5 today. And then one at which we're going to look at the actual like real life, Nike, Tesla type of example. All right. But with that said, what I want you to remember is that we look at liquidity ratios for a company to assess to what extent are their current assets liquid. To what extent can they translate that into cash or help them make cash? That's the whole idea of this thing that we call a liquidity ratio. All right. So also what I did here is I tried to highlight the most relevant ratios that have been seen in past exams. If we look at here, you have 4 pages worth of ratios that you could learn, but these ones are really the ones that I've seen on at least 4 past exams. So if anything, please try to remember these ones, okay? Please, at least these ones. And then the rest, I suggest that you kind of look at them quickly if you have time. So That said, let's jump straight into it. All right, let me make this a little bit bigger such that we have room for our definitions. Okay, so a quick ratio. Does anybody here know what a quick ratio is? Does anybody have an idea of what it means? Yes, no? Have you seen it? What are the vibes? Okay, Leandro says no. Somebody else? Okay, cool. Nice. Okay, so we're not too sure. That means that we could spend a little bit more time on it. So when we're looking at a quick ratio, I'll give you the formal definition, okay? And I think it's more relevant if we look at the formula first. I would recommend everybody here, by the way, this is how I studied. Don't mind me, I'm trying to find a paper. How I would recommend going about this, okay, is every single thing that we're gonna look at today, I would recommend that you have a piece of paper or your computer, whatever works best for you when you take notes, and write the name of the ratio, write in which category it goes in, and then literally write the formula and your like self-written notes around it. You're probably not going to want to study this alone after. So now's the time to really try to have some active recall. So I would please recommend you all to do that. Okay. And yeah, pretty relevant stuff. So the quick ratio, what it is, the formula that we're going to look at here is pretty straightforward. We're going to look at current assets, okay, minus inventories, minus prepaid expenses. Then we're going to do that divided by its current liabilities. Okay, so the first thing that I'd like to share here is that the quick ratio is probably the one that you'll see the most. Now, the first two things that I'd like to say here as a trick is that because it's quick, we're probably only going to look at current assets and current liabilities. That's like a trick to say, okay? Because it's quick, we're going to quickly look at current assets and current liabilities. So already there, we're able to identify our numerator and we're able to identify our denominator. The only thing that we're missing here for this formula is inventories and prepaid expenses, okay? So the way I would think about it, if you're thinking about the quick ratio, you want to think about it quickly. Okay, what are the two things that we're going to look at? Okay, current assets and current liabilities. But you don't want to be so quick, all right? You want to be quick, but you don't want to be that quick. So remember to add inventories and prepaid expenses, right? What I'm trying to do now is just going to give you like ideas and funny ways to remember these things, but that's the idea. So in terms of definitions, okay, you want to know whether a company has enough assets, i.e. current assets, to cover its immediate liabilities, all right, without having to sell any of its stock that it has now, right? So before we go deeper into this, what I'd like to say is let's try to create our little company, okay? We're going to create our little ISMA Helps company or whatever we're going to call it. We're going to call it the Bootcamp Company or 217 Company. So we're going to try to think. So we have our little company, all of us together, and we're going to try to make sense of this, okay? Let's say we sell phones, okay? So we sell phones to young adults at Fairview, Point Claire, and Centre Eaton downtown, all right? Pretty straightforward. Now, what we want to figure out is, let's say we had liabilities of $5,000 each month, okay? These are our monthly liabilities, okay? So the quick ratio, what it's trying to do is trying to see, well, how much current assets that you have right now that could cover these monthly liabilities, these current liabilities that we have, right? Let's say we have a current set of liabilities of $5,000. We would need to see to what extent are we able to cover our current liabilities with our current assets minus inventories minus prepaid expense. And we're kind of like taking our time to make sense of this, but once we apply this framework, it'll make sense for the next ones. So let's say that our current assets minus inventories and prepaid expense minus inv minus PE was equal to $5,000. Okay, and this is, whoops, this is going to be monthly. Wait for it. I'm going to give you a question in a second. It will all be worth it. So, okay, let's say we had $10,000. And we know that these are our monthly liabilities and our monthly current assets minus inventories and prepaid expenses. How many months can we last? Can somebody tell me how many months will we last before we go bankrupt? I need everybody to give me an answer. How many months will we last? Daniela, Hussein, we're missing, I believe, Alexandra. Yeah, Alexandra. Okay, cool. Okay, amazing. So I think we're all pretty smart enough to understand that we could only last 2 months, right? Okay, amazing. Now, assuming that this is our current assets minus inventory and prepaid expense, and this is our current liabilities, can somebody calculate what's our quick ratio with this formula? Can somebody give me that answer with the numbers that we just had? And it's okay if you have to repeat yourself in the chat. Can somebody give me the answer? Exactly. Hussein, exactly. Exactly. So what this formula does, it's honestly just looking at how many periods we could last. Now, depending on the question, they may give you for the year ended. So it's for every year. In this case, we looked at every month. But what I'm trying to say here is that when you do this divided by this number, you get 2, i.e., you can last up to 2 months. And that's as easy as this formula is. And this will be as easy as all these different formulas that we're looking at. What we're looking at right now is how much money do we make within this year, okay? How much obligations do we have within this year? Let's see how long we could stand with those obligations, okay? It's as easy as that. Let me give you one final example before we move on, and we'll kind of like write down our definitions. Let's say that our obligations were minus $1,000 and we had 100K, $1 million. How many months can we last? The number was there, but I'll still ask you to do the calculation just for fun. How many months can we last if our obligations are of $1,000 per month and our assets per month is current assets minus inventories and prepaid expenses is of $1 million per month? How many months can we last with our understanding? Can somebody write in the chat? It's the same thing that we did before. So we have a monthly obligation of $1,000 and we have current assets minus inventory minus prepaid expenses of $1 million. How many months can we survive? Oh, sorry, by the way, Leandra, fair point. The minus, I just put it there because I wanted to tell you like, hey, we're losing money, but ça revient à la même chose. It's the same thing. Like it doesn't change anything. But let me go back to this though, everybody. We have $1 million in current assets minus inventories and prepaid expenses, and we have $1,000 of monthly obligations, right? So how many months can we go through, assuming we didn't have to sell anything with these two numbers? How many months? Look at the formula and literally look at what we did before. It's literally the same thing. I just want somebody to give me the number. Look at the formula. Okay, Daniela gave me an answer. Is that true? Do people agree with that? Okay, amazing, cool. Yeah, so in this case, you could last up to 1,000 months. Okay, now, Leandra, is that clear? Do you understand how we just did 1,000 divided by a million divided by 1,000? Okay, Hussein as well, makes sense? Okay, cool. So the last thing I'm going to do is just to be really, really annoying because this really sets the foundation for our next questions. How many years will we last then? If it's 1,000 months, just for fun, how many years will we last? How many years will we last? We know that there are 12 months in a year. So what is the number? Amazing, cool. Okay, 83 years because there's 12 months in a year, all right? No, it's all good. Yeah, it's all good, man. It's all good. It's all good. So yeah, we have that. Okay, so this is really important. This, I just want y'all to really remember this. And the reason why current assets minus inventories and prepaid expenses is a really strong thing to remember for our numerator is because we want to figure out how much, how long can we survive without having to make sales, okay? This is exactly what we're trying to figure out. Now write it here in our implications. How long can the company survive without making sales? All right. I'm gonna write here, and that's why we don't consider inventories and prepaid expenses. Okay. Very, very, very important stuff. All right. So I'm kind of like trying to build our table as we go. Okay, so that's pretty clear. Now let's write a definition. We'll write it together. So the sorry about that. I'll go like this. Okay. The quick ratio measures whether a firm has enough short-term assets to cover its immediate liabilities. Really, as simple as that. All right, so this one we could round text as well. Okay, really good question, Daniela. Really good question. So in the exam, I only use this. This is all that you need. I was just being annoying because in the future, we're going to look at different turnovers. And I want you to understand and visualize these things from the very get-go, right? Because we're fresh and we're still here. But on the exam, just use the formula. Everybody on the exam, just use the formula. Okay. So really, this is what it means, in my opinion. Not even in my opinion, in like the actual example. So in our example, it depends, Usain. So on the exam for this one, they'll actually just ask you for the number. But when we're going to look at turnovers, they're going to ask you for how many periods or years this actually represents. And we'll have a few examples of that. So no worries. Yeah, so in our example, we could last up to 2 years. And I guess we'll kind of skip the hard examples because it's going to be quite extensive. All right. Sorry, I'm an OCD, so I love making sure everything's formatted. But yeah, okay. So really quickly, before we move on to the next one, what I'd like to say is that we have our quick ratio. That's a liquidity ratio. We're trying to see how liquid a company is. The definition here is that the quick ratio measures whether a firm has enough short-term assets to cover its immediate liabilities. Okay. Now, this will tell us how long the company could survive without making sales, and that's why we don't consider inventories and prepaid expenses. I'll put here interpretation. Actually, so on your on the sheet I sent in the chat, what this says is that, and this is maybe something that you could think about for your assignment that's due, I believe, on Monday for ratios. I could be wrong on the exact timeline, but you want to know that ratios less than 1 are not a good sign. Therefore, the company should try to proceed with caution. Why is that the case? Because they won't be able to survive. All right. I'm kind of I'm not an extremist. Sorry, that's not what I wanted to share. But I like to look at this perspective from an extreme standpoint. We're going to look at the company like if they're not able to cover their liabilities, they'll die. Like their company's over. Okay. So that's why within the rest of our conversation today, we're going to think about surviving. How does the company maintain their survival? Okay. So before we go to the next one, is this one cool? Are we happy about this? Like, are we comfortable? Okay, cool. Amazing. This is something that you typically see on your exam. So this is really cool stuff. Okay. So now let's try to make sense of our current ratio. All right, so the current ratio, it's really cool because it's the easiest ratio out there. The current ratio, can somebody tell me in the chat what it is just for fun? Because it's really easy, but it's very similar to our quick ratio.
It's only current assets over current liabilities.
Exactly. It's very simple. It's current assets divided by our current liabilities. Now, if you want an active recall here, there's actually a simple one. It's the current ratio. So you only look at what's current, i.e. your current assets and your current liabilities. Super simple, okay? You're literally just looking at current, so current assets, current liabilities, okay? Pretty straightforward stuff. So that's fun. Let me just, okay. So that's pretty fun. So let's try to make sense of this, all right? What we're trying to see here, it's not the same as our previous one, which is the quick ratio. We're trying to see how long can we survive without having to do any sales. In this case, we're not looking at that. We just literally want to see, are we able to cover our current liabilities with our current assets? So are we able to, on a day-to-day basis, on a month-to-month basis, live, breathe a little bit, okay? That's the idea. We're going to look at a quick, very simple example, all right? So we're back at Comp 217 Bootcamp. You know, we're killing it. Life is dope. You know, we sell phones. So what we're going to look at now is we're going to look at a few things. We're going to look at cash, inventories, prepaid expenses. Okay, these are obviously our current assets, just to make it clear. And then we're going to look at accounts payable. What else? Just for the sake of being accrued liabilities. So we have our current assets and we have our current liabilities. Let's say that we have $4,000 in cash, $20,000 in inventory, i.e. phones. Then our prepaid expenses are of $12,000 because we paid for our rent in advance. Call it prepaid rent or whatever. That's not a problem. Okay, and our accounts payable equal to $20,000. And our accrued liabilities is equal to $10,000. Can somebody tell me whether, and all of this is on a month-to-month basis. So we're looking at just 1 month. Okay, so can somebody calculate what the current assets, what the current ratio will be? What will be the current ratio here? What is the current ratio here? So Daniela says 1.2. I would need like, okay, one more answer. Okay, amazing, cool. So yeah, it's crazy and I didn't even prepare this. It just gave us a perfect number, 1.2. I'm kind of proud. So what this tells us here is that our current assets, the stuff we make every single day, okay? We sell phones every single day and we paid for our rent in advance. And we sell, and we have payments that we owe to Apple and LG and Samsung type of thing, okay? But this tells us that we're able to sustain our business, all right? But then let's say that we had $90,000 worth of debt, right? For our month. Now this means that we're not even able to cover our stuff. We're not even able to cover what we owe in liabilities on a month-to-month basis. So essentially, this is just a really good line in the sand to tell us whether we're on the good side or the bad side. There's not much more that you need to understand here. This is really one of the easier ones, all right? So pretty straightforward. What I'd like to share here, I'm just gonna do this. Sorry about that. Okay, so the current ratio measures the ability of a firm to pay its short-term liabilities with its short-term assets. All right, pretty straightforward stuff. Now, the implications for a business really, I think we go back with, it's a solid line in the sand to understand the state of a business. And by the way, if we have time after, I'll actually not help you do your assignment, but I'll give you a random company and we'll walk through it together to identify certain ratios if we have time at the end. I think that could be pretty helpful because I know you guys all have something due in a few. So yeah, super solid line in the sand. All right. Now, the interpretation verbatim is that really, the higher it is, the better a company is able to pay off its current liabilities. So the higher the current ratio, the better a company, a firm's ability to pay off its immediate obligations. All right, pretty simple. Before we proceed, quick question. Are we okay with this? This one's really easy, so that's why I'm not trying to spend too much time. Are we okay? Like, quick yes or no? Do we have any questions? Like, is there something that's not too clear? Is there something that you would rather look at? Now's the time. Okay, I think we're fine. Cool beans, cool beans. All right, sounds good. Okay, so that's pretty cool stuff. Now, let's try to make sense of this receivables turnover ratio. What is that all about? Now, before we proceed, what I'd like to highlight is something that I want all of you to remember. And this is also in my video. When we're looking at something related to a turnover, okay, you always want to remember that whatever is provided in the name of the turnover will be in your denominator, okay? So what I'm trying to say here is that if we're looking at receivables turnover, you must remember that trades receivables or accounts receivables will be in your denominator. That's what we're going to divide it by, okay? And if we're looking at payables, then it's going to be accounts payables that will be in your denominator. And if we're looking at inventory, you're going to be just looking literally at your average inventory. Okay, that's the first thing that I need us to always remember. It's like an active recall, super important. The second thing that I'd like to share is that if we're looking at something that has to do with a turnover, what will be in our denominator that we already know is identified will always be an average of 2 years, unless said otherwise in the question because it didn't give you the data. Okay, so let's circle back. There's two things to remember when we have a formula that has turnover in it, okay? The first thing is that the title of that ratio, either receivables turnover, payables turnover, or inventory turnover, will always be in your denominator, okay? And the second thing is that whatever that title in your denominator, it has to be the average of 2 accounting periods, usually of 2 years. It will not be 2 years, so an average, if they tell you so, all right? Super duper important. It really makes a difference. Okay, so with that said, let me ask you a question. What will be in our denominator for our receivables turnover? Can somebody tell me in the chat? What will be our denominator? What are we going to divide it by? Daniela says accounts receivable. Okay. Somebody else? Do we have other ideas? Leandra says agreed. Amazing. What else? Okay, good stuff. Really good stuff. I'm happy about that. This is like the rule of thumb. Okay, but is it accounts receivable for 1 year or is it average account receivables? Thank you. Okay, so now we know that. So what I'll do here, just because I want you to remember this forever, is we're going to have our average accounts receivable. But just to be clear, what they're usually going to use on the exam, they're probably going to call it trade receivables. So I'm going to call it trade receivables, but account receivables and average trade receivables is the same thing realistically. So now let's try to figure out, well, what has to be in our numerator? What are we going to put there and why? And here, what we want to do for 3 different types of turnovers for our liquidity ratios, we need to try to make sense of what is short-term and what goes really well with our denominator, okay? So in this case, we want to figure out, 1, what is short-term and what goes well with trade receivables or accounts receivables. Now, what is an account receivable? Why do we have an account receivable and when? Can somebody answer me? When do we have an accounts receivable? I think that's an important question. When do we have an accounts receivable? Like there's no right answer, by the way. It's an ambiguous question. Okay, Daniela says when people need to pay us. I love that. Somebody else, another perspective. I need everybody to throw something at the chat. When do we have a accounts receivable? Like what, why, when, how, where? Answer these 5 W's. Okay, Leandra, you killed it. Amazing. Yes. Okay, I need one more. I just need one more answer. One more answer. When do we see that? Where, when, how? I need one last answer in the chat. I'll give you like a minute. Okay, well, whatever. So yeah, the idea here is that we're looking at accounts receivables when we're supposed to earn money in the future, right? When somebody's supposed to pay us. But by definition, if somebody paid us cash, then there's no reason for us to have an accounts receivable. If somebody did not pay us cash, then we have a reason to have accounts receivables. So by definition, the thing that goes most hand in hand with this idea of accounts receivable is this idea of cash. And that's why we're going to put it as our numerator, because it's the thing that we would like to compare to our trade receivables, right? We would much rather cash than receivables, because cash today is better than cash tomorrow, okay? And for that reason, we're going to have cash and cash equivalents, cash plus cash equivalents in our numerator. So are we okay with this? Do we see why it makes sense to compare our cash to our accounts receivables? Yeah? Like just quickly off the top. Like, does that make sense? Cool, amazing. Good stuff. So what is cash equivalent? Good question, Leandra. It's literally money that's not necessarily cash, but that could be turned into cash tomorrow. So for example, your investments in your TFSA or a loan that you gave, money that you put in the bank, those are all things that can be turned into cash immediately. So that's what it means for a cash equivalent. This is just them trying to be fancy, okay? So, okay, really good question, Hussein. So no, inventory is not equal to cash equivalents, because when we talk about cash equivalents, it's literally something that could be turned into cash within 5 seconds, you know, nowadays, right? Your money in the bank account and your savings could be put into cash immediately. Your money in your TFSA realistically could be put into cash immediately. You don't need to have anybody buy something from you. However, inventory, merchandise, and all that good stuff, it has to be sold, and it has to be sold at a premium versus what you bought it at, right? So it's not as liquid. So that's the difference between the two. So once again, we compare cash to trade receivables because we would rather cash, and if somebody did not give us cash, then it becomes a receivables, okay? So that's this idea here, okay? Now, this begs a question. Let's look at another example. Let's kind of jump back into it. All right, let's go back into it. So here we're going to have our receivables turnover. Our receivables turnover. Let's say that we have cash for this month. We received $5,000. Okay, but we had accounts receivables of $50,000. Okay. Let's assume there's no average. We don't need to look at that. All right. What's really interesting here is that, are we making more cash or are we making more accounts receivables? What do we have more of? Somebody tell me in the chat. What do we have more of? cash or accounts receivables? What do we have more of? Like, what's a bigger amount? We have more cash than accounts receivables, or do we have more accounts receivables than cash? What is the biggest account in front of us right now? Yeah, the biggest account that we have right now is accounts receivables. Okay, really, really important. So two things. Our assets are still equal to $55,000. I think we could all understand that. However, what this means though is that we don't have a really good ability to make our money, like to make our transactions into cash. Like what I'm trying to say here is that we have a lot of receivables, but we only have a little bit of cash. So this means that, let me give you an example. Let's say a phone costs 500 bucks, okay? Price, phone money per unit, okay? So, and all of this came from phone sales, okay? All of this came from phone sales. Some people gave us cash, some people gave us accounts receivables. Like they said, we'll pay you in a week type of thing. How many phones did we sell? How many phones did we sell? Really quickly. But we sold these phones. This is from our transactions with phones, but they just didn't give us cash. I want to know how many did we sell, not how much like cash did we make. Yeah. So we sold phones and we had $5,000 in cash and $50,000 in accounts receivables. Like they're gonna give us money on another date. So how many phones did we sell? Amazing. Okay, does everybody understand that we have 110 phones that we sold, right? Amazing. So we sold 110 phones. However, from those phones, only $5,000 came into our pockets. Only 5K actually came into our pockets in cash. And we are still owed $50,000. Does that mean that we are an efficient business? Yes or no? Are we efficient to get cash? No. Right? Let's say we had to pay rent and rent is $12,000. Are we able to pay our rent if we only have cash? Are we able to pay our rent if we only have 5K? Hell no. But we're going to go tell our landlord, hey, sorry, we got 50 grand coming in like a week or two. Our landlord wants the money today. So for that reason, why this is an important ratio is that it tells us how efficient is the company to turn its transactions, in other words, its accounts receivables, into cash. In this case, we are very inefficient because for every dollar that you make, right, that you have in cash, you are owed 10 times that. You are expected to receive 10 times that, but you didn't get it, right? That's a very scary business to invest in, right? Because what if somebody decides to not give you your money, right? You never got the cash in hand. You were never able to do anything with the cash. What if you need to give them, it becomes bad debt. They just never do so. So it has a lot of implications. And for that reason, the receivables turnover ratio is really, really, really important because it tells us, and I'll give you the word for word, it measures how many times a business can turn its accounts receivables into cash during a specific period. Okay, it's trying to see how many times can you turn your average accounts receivable into cash. In this case, it's telling you that you could not even do it once. The cash that you received this month or year, whatever, only 10% came from your accounts receivables. That's not really good, okay? So really important implications, all right? Very, very important implications. So we're looking at a specific period, okay? So by definition, what I'd like to say is it's a pretty interesting idea. This is something that you may not see on the exam, but I'd like to cover it a little bit. And it's the idea of average collection periods. Right? Pretty solid stuff. So this is how many times we could turn our accounts receivables into cash, i.e. only 0.10. The average collections period, okay, and let's say this is per month. So 0.10 per month. The average collection period, what it's trying to do is essentially it's trying to see, well, how many times could you earn your cash, essentially? How many times can you get your money back? How much time it takes to earn your money in a year? So essentially what I would like to say here is that the formula is 365, so 365 days divided by your receivables turnover. And this will tell you how many times, how much average days it takes for you to get your money. So can somebody tell me, in this case, if our receivables turnover is 0.10 and our formula is the following, how much time does it take on average to get our money? Can somebody tell me that? How many days on average does it take for us to convert our accounts receivables into cash? Can somebody tell me that? How many times? Nice, good stuff. So this means that it takes us this many days to get our cash back. This is some ridiculous stuff. This means that it would take you 10 years, right? This is 10 years, 10 years worth. It would take you 10 years to make your accounts receivable become cash. If we owe $12,000 in rent per month, we are living on the streets. You know, we're living on the streets because we can't even tell our landlord, hey, give me 5 days. But then you know that your average collection period is literally 10 years. It's a very extreme example. Now let me just give you a normal example. Okay, let's say that our accounts receivable is 12,000 and that we have 55,000 in cash. Okay, so now our receivables turnover is 4.58. Can somebody tell me how many days it takes for us to be able to get our money into cash? Can somebody do that little exercise for me? So 365 divided by 4.58, that would be our formula for the average collection period. And that will tell us how long does it take for us to convert our accounts receivables into cash. So yeah, 79.64 days, which is still very long, right? A business should not be taking 3 months almost to turn its accounts receivables into cash. So this was us taking quite a bit of time just to get a better sense of how long does it take for a business to turn its accounts receivables. So before I go into the interpretation, I kind of spoke for a bit. Do we follow? Do we understand why this matters? Can we see why that's pretty important for a business to know? 100%, right? Because how can you make a decision on an investment or on rent or on new employees if you don't know how you're able to convert your credit sales into cash, right? It's very, 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 very important to understand, okay? And by the way, I just want to change what I've put here. This will be our net credit sales. I don't know why I made that mistake. We're trying to see our credit sales. If we do credit sales, that's because we didn't get cash. So this will be our numerator, by the way, sorry. So our interpretation here is really simple, right? I think we could all see that. Okay, tell me, the higher our receivables turnover, is it the quicker or the slower we get our money? Somebody tell me, the higher our receivables turnover, the quicker or the slower we get our money back from our customers. Okay, amazing. Okay, cool. Vous êtes des pros, y'all are pros. Yeah, so the higher the ratio, the quicker the business, the firm's ability. Firms, trying to write English. To convert their receivables. All right, so that's pretty cool. I think that went fairly well. No, Daniela, that was actually like a mistake of mine. Net credit sales is not equal to cash plus cash equivalents. I just I blundered. I looked at the wrong thing. So please remember that net credit sales is very much attached to average trade receivables. The case is because you could only have receivables if you accept credit sales, right? If your sales were all in cash, then it's not representative of your average trade receivables. So just please remember that. That said, can I ask y'all what would be on our denominator for the payables turnover? What would be in our denominator for our payables turnover? If you guys remember what we said last time. Okay, Daniela, I think you're making the same mistake as last time, but you have the right answer. You missed one word. There you go. Exactly. Yeah. So average accounts payable. Is that clear for everybody? Do we understand why it's average accounts payable, our denominator? So I'm asking Leandra, Hussein, Alexandra, everybody. Does that make sense? Yeah, perfect. Cool. Amazing. Good stuff. So average accounts payable. Nice, 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 nice. So we're looking at payables. Now, on an exam or on a question, they may have accounts payable and they may have trade receivables. So depending on the case that you have, you may have to like adjust yourselves. So just to be annoying, I'm gonna write trades payable, but it's the same thing as with accounts payable. Okay. So same question as last time. When would you have an accounts payable? In what scenario would that make sense? When would you owe somebody money? In what instance? When you did what? Right? A trades payable. When would that be the case? It's an interesting question. Daniela has an interesting answer. It could be right, it could be wrong. I don't know. I need 2 more people. Okay, Hussein has an interesting answer as well. I need 1 more answer. 1 more answer. What do y'all got? It's fun stuff. What do you got? What do you got? It's okay. So Leandra says liabilities. These are all amazing answers, and that's why I wanted to take the time to look at it. When we're looking at trades payable, we're looking also, by the way, at short term. I'm sorry I didn't like reiterate that. We're looking at short-term ideas, right? So what are typical short-term liabilities that a company may have? It's either, as you guys said, borrowing money, but it could also be when they make a purchase on credit, right? Let's say the company decides to buy, we decide to buy 20 million phones from Apple, right? But we can't pay all of that in cash immediately. So we decide to have a trades payable. We owe them money such that we're going to pay them in cash later. The idea here is that what you want to do with payables turnover is that you want to look at your purchases as your numerator. You're looking at your purchases over your average trades payable. You're trying to see, well, those purchases that I made, how much do I actually owe vis-a-vis them, right? Am I making a bunch of purchases on debt, like on a future obligation, such that in the future I'll have to pay a lot of money? Let me give you guys an example, okay? But Daniela, you had an amazing answer. It was the right answer, okay? So let's go back to our examples. So here we're going to look at our payables turnover, and this will make more sense in just a second. Payables turnover, all right? Average days. All right, so let's look at our purchases. Let's go back at our example. We bought 900 phones. Okay. We bought 900 phones and they cost us 500 bucks each. Okay. Can somebody tell me how much it cost us to purchase all those phones? Phones are costing us 500 bucks each. That's our business. And we bought 900 of them. What is the amount? Thank you so much. Yes, yes, yes. Well, whoops, should be 900. Yeah, so that's the value. Good stuff. Okay. Now, let's say that our accounts payables let's say that our accounts payables are 350,000. Can somebody tell me what our payables turnover is? If it's 350,000. If it's this amount, what is our payables turnover? Thank you. Yes. Okay, cool. So essentially, this means that we have made $450,000 worth of purchases. Okay. Yet, of those purchases, we have still $350,000 in obligations to those suppliers. In this case, to, let's call it Apple. Supplier is Apple. All right. So this is a very important thing. This means that we made $450,000, that we purchased $450,000 worth of phones, and we still owe 350K in, call it trades payables. Okay, so let me ask you a question. What are the hypotheses that we could have here? This could mean that of those purchases, we spent 100K in cash and that we still owe 350K. That could make sense. But then what does this mean for the business? Does it mean that we are able to pay our suppliers, or does it mean that also that we're not doing a good job paying our suppliers? Like, what is this telling us of our relationship to our suppliers and those transactions? What does it say? If we made 450K in expenses, like we purchased $450,000 worth of phones, but we still owe $350,000, what does that say? Like, any answer is correct here. Like, there's nothing wrong. Okay, that's a good one. I like where you're going to, saying, yeah. So it says that we're not able to purchase everything in cash. That's very, very interesting. Okay, what does it say to our suppliers? What else? What else does it say? Okay, no problem. So let's use a different number. Let's say that, yeah, sure. Okay. So we purchased $450,000 worth of phones. In other words, we purchased 900 phones. But in our accounts, we still have $350,000 in trades payables. Okay. What does this say about our relationship to our suppliers? What does this say to our suppliers? Okay. That we purchased $450,000 worth of their phones, and we still owe $350,000 worth of that. What does that say? Oh, Leandro, you're going in the right path. Hell yeah. I like that. It says that, okay, let's go with this. I need one more thing in the chat, and then I'll stop asking and I'll run with the explanation. So it says that it's risky. I like that idea. Let's run with this. Yes, Hussein, there you go. Well said. Exactly. It says that we are not really capable of paying the money back anytime soon, right? Imagine you make a purchase of $450,000, yet you still owe $350,000 worth. Whoa, this means that we're really doing a bad job paying our money back, right? And if we look at the formula we had before, this means, if we use our formula, that it takes 283 days for us to pay our suppliers back. If you're a supplier, do you want to like make a sale with us? If you're a supplier and you know it takes 280 days for you to get your money, would you be down with it? Or would you say, you know what, maybe not? No, exactly, right? It's very clear. Now, let's say that our trades payable was, and actually before I do that, I'm going to hide this. Okay, I'm going to hide this just because I want to be annoying. Okay, so now the last thing I'd like to share here is that let's say our trades payable was 25 grand. Okay, what would be our payables turnover? If our purchases is equal to $450,000, and our trades payable is $25,000, what will be our payables turnover? Exactly. You did well. Yeah. Did everybody get to 18? Quickly, yeah, cool. All right. Then somebody other than Alexandra, could you tell us what is the average days payable outstanding? Like how many days does it take for us to pay our suppliers? I want somebody else to give it a shot. Just make sure everybody's working. Leandra says 20. It's 18. Yeah, some run. Yeah, 20. So it takes us 20 days on average. Then honestly, for me on the exam, because it's in person and it's written, I would literally write 20.28, and then you could say, you could round it up to 21. Like I would write that on my paper. That shows that you are a smart and capable like financial accounting student, because you understand that it's impossible to have 20.28 days. So you'd round up to 21. But you want to make them understand that you have the correct answer. Okay, so now, if you're a supplier, would you be willing to do business with us? Yes or no? Hell yeah. Okay, cool. Amazing. So that's the idea. It measures how quickly the firm is paying its suppliers. So literally, how long does it take business to pay its suppliers? I really can't see anything else to say here. The interpretation. Okay, so with our example, the higher this ratio, the better, or the smaller this ratio, the better? The higher the ratio, the better? The smaller, the better? Daniela, are you sure?
It doesn't mean it takes us less time to pay.
Oh, okay, my bad. Okay, I see what you mean. I'm talking about this ratio, by the way.
Oh, okay, so I'm confused.
Yeah, the payables. Yeah. So the higher a payables turnover ratio, the better, right? Because then it means that this number here would be smaller. What I'd like to share here is that the average days payable outstanding or the average days receivables outstanding is what I would like to call a really good sense check. It's an amazing way to just make sure that we're going in the right path, and that we're able to understand and determine the scope of our answer, okay? You don't necessarily have to do this, but it's a really good way to put it into perspective, and that's exactly what we did. So to really like break it down in a simple line is that higher ratios show suppliers and lenders that the firm is capable of paying its purchases, obligations quickly and regularly. That's how I would go about sharing this message. Okay, so 2 questions. How are we feeling? Are we feeling still awake? Are we still here? Yeah. And then the second thing is, so the way we're looking at each ratios, it's taking a little bit more time, but do you think it's effective? Or should I just maybe just go quicker and just tell you what it is and finish there? Or should we go with the example perspective? So do we keep it as is, or do we go quicker for the ratios? What do y'all think? It's for you guys. Like, do you like the way I'm showing it right now? Or would you rather, okay, cool. Anybody else really quick? because I don't want to make you feel like I'm wasting your time or anything. Okay, cool. No problem. Amazing. Okay, so by the way, a lot of these different formulas are going to they become really easy. Like the market test ratios take 2 seconds to understand, and then the solvency ratios are probably a little bit harder. These are pretty easy, so it gets easier. Okay, so that said, what would be in our denominator for our inventory turnover ratio? What would be in our denominator for our inventory turnover ratio? What would that be like? Yes. Nice, exactly. Already in caps too. Average inventory. Hell yeah. Okay, cool. And then what would be, if somebody had to guess, what would be on our numerator? What is something that we looked at extensively in chapter 7 when we discussed this idea of inventory? What is something that inventory typically has to deal with? Okay, y'all are pros, exactly. Cost of sales or cost of goods sold, same thing really. So super duper important, right? Very, very, very important. So what we want to see here, and this one essentially is interesting because purchases and cost of sales, as we saw in our in our chapter 7, obviously I'm not sure I helped everybody here with that chapter, but we saw that cost of sales and purchases are not the same thing, right? And they're part of a formula. And I'll write down the formula here just to for you to remember. So it's cost is equal to beginning inventory plus purchases minus ending inventory. I'm pretty sure that's what the formula was exactly like. Is this correct? Do you guys remember this formula? Beginning inventory plus purchases minus inventory will give you your cost of sales. Do you guys remember that formula from chapter 7? Yeah, okay, cool. So quickly, what I'm trying to say here is that cost of sales and purchases are not the same thing, okay? Cost of sales is really telling us, well, what was this inventory cost that we've attached to this transaction that we did, right? If we know that we sell our iPhones at $1,000, but an iPhone cost us $500 to buy, well, on that specific transaction, it costs us 500 bucks to make that sale, okay? So that's why it's really important to understand the relationship of the inventory cost attached to a transaction with our total inventory. Because what we're trying to see here is we're trying to see, well, how efficient are we on selling our inventory? And how efficient are we to get some inventory back, right? Let me give you an example. Okay, let's go with an example. Let's say inventory. Let's go with cost of sales. Here we go with inventory. Okay. Let's say that it costs us 150 bucks to do this. Sorry, I'm just building our example really quickly. And we're gonna put this into white as well. And here we're gonna say average days. Okay, so this is sale price, and this is cost. Oh. Okay, sorry about that. I was just trying to make this a little bit interesting. All right, so, okay. So let's say, sorry about the delay, but let's say that a phone, we sell it at 400 bucks and a phone costs us 100 bucks to purchase. And let's say that we have 1,000, we have 500 phones in inventory and we sold 300 phones. Okay. So that's how it would usually look like. So I want you to tell me, what would be the cost of inventory? What would be in our, like, what would be the value in our inventory? If we know it costs $100 per phone and we have 500 phones in inventory as of now, what would that number be? What would be in our inventory? What would that, like in our assets, in our statement of financial position? What would be the value? Okay, Daniela says 50K. It could be right, it could be wrong. I need one more person to tell me. Nice. Cool. Yes, it's the exact amount. So yeah, that's exactly what we have in our inventory. All right. But now we know that we sold essentially 300 phones, and we know that it costs us $100 per phone. So what is our cost of sales? Cost of sales, not the profit per sale or like the revenue per sale. I want the cost of selling one phone. But right now we sold 300 phones. So it'd be 300, but would it be 300 times 400 or 300 times 100? Exactly, there you go. It'd be exactly that. So now we know, all right, that we have $50,000 in inventory and we have $30,000 in our cost of sales, okay? So what we're able to see here, if we divide our cost of sales by our inventory, can somebody tell me what that would be? If we divide our cost of sales by our inventory, what amount would that give us? If we divide our cost of sales by our inventory. So, okay, amazing. It's no worries. Okay, so before we proceed, I like to look at this from a logical perspective. What does this number tell us? Does this number tell us that we sold all of our inventory? Or does this number tell us that we did not sell all of our inventory? Somebody tell me, what does this mean? Yeah, so we did not sell all of our inventory. In fact, we have $20,000 worth of inventory left. Can we all agree to that? Yes or no? Okay, cool, amazing. So this tells us that, hey, you still have, some inventory left, right? Your cost of sales, right? Then this also tells us that the amount of phones that we sell is smaller than the inventory that we have. Does that make sense? The amount of phones that we sell is smaller than the amount of inventory that we have. Yes or no? Does that make sense? The amount of phones that we sell is smaller than the amount of inventory that we have. Yes or no? Okay. I don't know if that makes sense. I'm gonna assume this makes sense. Okay, cool. So the amount of phones we sold, i.e. 300 phones, is smaller than the amount of inventory that we have at hand right now. So this tells us that maybe we have too many phones in inventory, right? Maybe because we know we only sell 300 phones per month, but we have 500 phones in our inventory, maybe it means that we're spending too much money. Does that make sense? Yeah, like I'm not seeing any answers, so I'm confused. Does it make sense? Like, do we understand this? Like, okay, cool. So yeah, the idea here is that this ratio tells us, hey, maybe you are having too much inventory. Yeah, okay, sorry about that. At first it was 800, but then less sale, right, of 300 will give you 500. Sorry about that. Sorry if that wasn't clear. My bad. Yeah, sorry. This is like our inventory now. So, oops. then this will be, okay, so sorry about that. So yeah, so do you understand how like, hey, you sold less phones than you have in inventory type of thing, okay? So this is just telling us, hey, perhaps you have an excess supply. Maybe you should hold less inventory because you actually don't need all that inventory. So what I'd like to say here is that this measures how many times a company, okay, how many times a company's inventory is sold and replaced in a period. But what you want to really see is the implication is that, is the firm holding excess inventory? Is the firm selling off all of its inventory? Because if the cost of sales is bigger than inventory, right? It means that the firm is doing a good job selling off its inventory on a period-to-period basis. Okay. So in other words, what would we want? Would we want a bigger turnover or a smaller turnover? Would we want a bigger number for this ratio or a smaller number for this ratio? What do y'all think? The answer says bigger. What do y'all think? Would you rather a smaller number or a bigger number here? Exactly. Bigger, higher ratios indicate, right? Higher ratios indicate that the firm has strong sales and is efficient in purchasing inventory. Smaller ratios indicate or imply, I would rather say, imply that the firm has low sales and or is inefficient in purchasing inventory. And I'd like to kind of circle back because what I'd like to also share, by the way, and this will make you, I feel like I have this teacher for mergers and acquisitions, FINA 415, and he always has this spiel about like, I want to make you guys the best interviewers or interviewees in the future, blah, 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 you know, for you to be really good students. And I really appreciate those comments, but it's corny at times. But I'm gonna have to do the same thing to y'all. What I want you to understand is that ratios only show one side of the coin, right? Because by definition, let's say the firm has $900,000 in cost of sales, but it has, call it $1.2 million in inventory. By definition, we could say that that's a smaller number. But it really does depend on the industry it's in. It depends in which business it's in. It depends what month it's in. Because sure, you could have a lot of inventory in, but if your cost of sales are ridiculous and you're charging a lot of money, then that's not a problem. So it's always dependent on the scenario, and having the ability to understand in which industry a company operates in, understanding which month we're looking at, understanding the cyclicality of the industry will all allow you to like actually derive this like the proper answer for this inventory turnover in all these different ratios. Just something that I like to share because it's pretty relevant for your project and future classes you take. So this said, are we okay with this? Was this like clear? Do we have any questions? What do y'all got? Okay, nice, amazing. All right, let's look at dividend yield. It's super easy. Essentially, what you could do here, and this formula, I'm not going to try to like explain it. It's really simple. We're going to look at dividend per share. You're going to divide it by the market price per share. What I want you to remember here is that for the dividend yield, they will literally rarely ask you this question, but in the case that they do, they're going to tell you what's the average dividend per share. It's going to be given in the question. Okay, they're going to tell you the firm is allocating $5 per share in dividends, or they're going to literally write it in the statement of financial position. Let me give you an example rather than just speak in air. This is a really good example right here. I'll zoom in, don't you worry. They'll tell you in your statement of financial position, hey, there's a $3 share annual dividend, or $3 annual dividend per share. Okay, so don't worry about that. And if it's not here, it'll be in the actual prompt. Genre, the firm just declared $4 dividend per common share. Okay, so they're going to tell you exactly what is the dividend per share. So never worry about that. Okay, and then the market price per share will also be provided like in the question. They can't ask you to go on Google during the exam and find the like market price. Okay, so that said, this may be something that you're not used to. So what I'd like to do, for example, is let's look at Apple. Okay, can somebody tell me what's the market share for Apple right now? Somebody go on Google and search Apple and tell me what it is. Somebody go on Apple and tell me what it is. I think it's, I don't even know what it could be actually. So just go tell me what is the market share price. It's $57. Sorry about that. Market share price. Oh, that's on me, Leandra. That's on me. That's on me. I'm sorry. Market share price. So the price on the market. I apologize. That's totally on me. Okay, Hussein says 170.09. Sorry, I didn't see that. I apologize. That's hilarious. Okay, so the market share price is 170.09. Let's say that the average dividend per share, okay, is equal to $2. Okay, so in order for us to be able to find the dividend yield, tell me what that would be, just for fun. If you know that one single share costs you $170.09 and you're making $2 dividend per share, what would be your dividend yield? What would be the dividend yield? Oh, by the way, if you want to see the formula one more time, by the way, what would be the dividend yield knowing that this is the formula? I need to see one more. That's nice. Good stuff. Okay, so this is our dividend yield per share. Okay, so this is if, and I'll bring this here. So per one share. Let's say that we had 5,000 shares, right? This remains and this remains. What would be our, what I'll ask you is this. What would be our total market share price? That would be the same. Hold on, I'm thinking about something. Okay, what would be our total dividend that we received if we have 5,000 shares? It's $2 dividend per share and we have 5,000 shares. What will be our average dividend per share? I mean, our total dividend, sorry about that. So we have 5,000 shares, it's $2 per share dividend. How much would be our total dividend receivable if we have 5,000 shares? It's pretty simple. Essentially, you multiply this by a number. What would it be? Nice. Does everybody understand why it's 10,000? Yeah, okay, cool. Okay. But what I'd like to share here is that, let's say, how much money did I have to spend today to have 5,000 shares? So essentially, I would multiply the market share price per share times 5,000. What does that give me? So if I wanted to buy 5,000 shares right now, live, I go on Google, I'm like, I want to buy 5,000 shares. How much would that cost me? of Apple, by the way. How much would that be? Nice. Can somebody tell me what's my dividend yield? It's the same formula, but just remove the per share. I want you to take this number and this number. I want you to divide this number by this number. Tell me what that gives us. This divided by this. Exactly. Notice how it gave us the same gosh darn it number. Give us the same number. So what I want you to understand is that the dividend yield, we don't care by how many shares we look at it. It's really relative, and it will remain the same thing no matter what. What I want you to understand is that the dividend yield really seeks to understand, because you notice how these two are different in two ways. The total, in three ways. The total number of shares is different by the total price you had to pay for those shares, and it's different by the total amount of dividends you are going to receive. But these three things are extremely common. They're they go hand in hand. And essentially, what the dividend yield is telling us is that we're trying to understand how much money will you receive in dividends for every dollar you invest in this company. Let me say this one more time. What this tells us is that how much money will you make in dividends for every single dollar you invest in this company, right? These are the same things. Sorry, and I talk a lot. My throat gets all messed up. But yeah, so that's what I'm trying to say here. So in other words, what this tries to do, it tries to measure how much a company pays out in dividends relative to its market share price. You're trying to understand. I think we could say that the implication here is pretty straightforward. How much dividend cash do you receive for every dollar that you invest in this company? So sorry, I'm just trying to make it nicer. Okay, so let me ask you this. The higher the dividend yield, like the better, or the lower the dividend yield, the better? Which one is better? So the higher the dividend yield, the better, or the lower the dividend yield, the better? Okay, that's one answer. That could be right, that could be wrong. What do y'all think? The higher the dividend yield, the better, or the lower the dividend yield, the better? What do y'all think? The higher the dividend yield? And there's no wrong answer. Just throw it out there. It's totally fine. Nice. Yeah, the better. And what's interesting here is that we could look at this from the perspective, typically, of the consumer. Because it's really more so for the investor, right? The investor would rather have more money that they make per dividend per money they invest in the company. So for them, the higher the dividend yield, the better. But in real life, what's really cool is that if investors are happy, the company is happy, because it means that their share price, the company's value in the market, will rise, will appreciate. So it kind of goes hand in hand. So that's why I'm saying that the higher the dividend yield, the better, right? On an exam, I doubt that you'll have this question, but I want you to have the head start for the next semester. So are we cool with this? Does this make sense? Happy? Yes, no? Clear? Cool. Okay, this one, similar, very easy. You're going to take the current market price per share. You're going to divide it by the earnings per share, which is also called the EPS. I'm going to be totally honest with y'all. I doubt that this will be on the exam, but it's still worth taking a few minutes to get a sense of it because you don't want to miss out on that opportunity to get 100%. So the current market price divided by the earnings per share. What's really cool here is that it's kind of similar to the previous formula, but we're just kind of swapping the numerator with the denominator and the denominator with the numerator, okay? So what we're trying to do with the price earnings is we're trying to see how many times does the current market price value the earnings that it's providing. So let me get a better sense of this for y'all. I think I can say that better. Let's go here. Okay. Net earnings of Apple 2021. Okay, so let's assume that the net earnings for Apple is equal to something like this. I don't know. It's possible. All right, let's say that these are the net earnings. Okay, that's kind of ridiculous, but let's say it's like $500 million. Okay. Okay, so let's say it has something like 37 million shares outstanding. Okay. What is the earnings per share? Somebody tell me, what is the earnings per share? If the net earnings of Apple is $500 million and they have 37 million shares outstanding, how much money is one singular share owed? Somebody tell me what that is. Nice. Okay. So what does this mean? It means that every single individual that owns a share in Apple is owed $13.51 if there were a dividend to be paid. Now, for y'all that don't really like this jargon, let me just make it simpler. Let's say that Apple was a private company and it was owned by one person. How much earnings will that one person get? Somebody tell me. If Apple was owned by one person, what would be the earnings per share for that singular person? If this is one, it'll be 500 million, right? What I'd like to share to y'all is that a share really represents, in an ideal world, a person, right? But a person may have several shares, but in this case, we'll say it's equal to one person, right? So if Apple had net earnings of $500 million, but it has only 5 shares outstanding, i.e. 5 people, then each person will be owed $100 million. Does that make sense? Do we understand the relationship here? Yeah, I think we'll have a break after this one. Yeah, I think that makes sense. 100%. So yeah, so now we get the picture, all right? So we know that the earnings per share is equal to $13.51. However, this would be awesome. Let's look at the market price. Let's go back to this. Okay, so let's do the PE, price earnings ratio. All right, so let's check this out. This will be very simple. Okay, so market share price. So if the market share price of Apple is 170 bucks, can somebody tell me what will be the earnings? What will be the price versus earnings ratio? Like, what would be the answer here? Remember that this is a formula: current market price per share divided by earnings per share. Okay, so if we know these are the earnings per share, and we know that one share of Apple is equal to this much, $170, what would be the price earnings? What will be the price earnings if we know that the market share price is 170 bucks and the earnings per share is 13 bucks? What will be the price earnings ratio? Somebody tell me. Nice. 12.59. Okay, that's a good idea. Okay, what if We have two what if. Okay. What if the market share price was $90,000? Okay, that's ridiculous. Let's call it 760. If it's 760, can somebody tell me what would be our price earnings ratio? What would be our price earnings ratio if the share price for Apple was $760? If the market share price, there you go. Nice. Cool. And then what if the share price was 34 bucks? Okay. What would be our ratio then? It's the last one, I promise. What would be our ratio then? Nice. Thank you. Okay. Okay, then let me ask you a very dumb question. Would you rather pay more money for a share or less money for a share? Realistically, if you wanted to buy Apple today, would you rather buy it at 34 bucks, 760 bucks, or 170 bucks? What would you rather buy it at? Somebody tell me in the chat. What would be the ideal purchase price for you to buy Apple within these three options? Right? Do we agree with Alexandra? Does that make sense for us to want to buy it at 34 bucks? Are we okay with that? What about Daniela, Leandra, Hussein? At what price would you want to buy this specific stock? Okay. Well, yeah, it's 34 bucks. No worries, no worries. It's 34 bucks. So, yeah, we'll take a break after this one, but it's 34 bucks. So if you would rather buy it at 34 bucks, by definition, your price earnings ratio would be actually smaller, right? Because 34 bucks and the earnings per share is equal to 13.51. Well, that's a really good sign that, hey, maybe it's better that our price earnings is actually smaller, right? But that's actually not the only perspective that you would want. A price earnings ratio really tells us to what extent are investors bullish. So to what extent do investors have faith in the company? Because if investors are investing into a company that has a very high PE ratio, such that it's $760, right? The share price, and they have a share ratio, PE ratio of 56.24, this means, or this implies that the market believes that there's going to be high growth for this company, for them to be able to justify spending so much money. Okay, so that's the idea here. It's this idea that investors are expecting higher earnings in the future. Okay, but it's not something that you'll have to really like define in the exam. You'll only really need to use the formula. So yeah, this measures the relationship. This measures the relationship between the market price and its earnings per share. Okay, and relative to the market, and this implies what investors believe the growth of this stock will actually be. And high PE ratios, if I go to the right, high PE ratios imply that investors are expecting greater growth and or earnings than firms with lower PE ratios. All right, so I know we talked a lot for 1 hour and 40 minutes. So I know we're a little bit tired. So I'll give us a 10-minute break. I'll give us a 10-minute break, and we're gonna get back into it, and we're gonna crank the last set of turnovers. We're gonna try to go a little bit quicker so we could do a question together. But doing the questions together will be super easy because once you understand them and once you know the formulas, it's literally a question of just putting numbers together. So that'll be fun. So 10 minutes break, we'll come back at 6:50. All right, 6:50. All right. Are we excited or what? Are we replenished with energy? Are we good? Do we have some energy for the next batch of questions? Let's go. Perfect, perfect. All right. Okay. We'll try to keep it at 5 minutes per question. I mean per little topic here, such that we could spend only 30 minutes on this, or like something like that. 30-40 minutes, and then we'll have the rest to do one big question like that. We could at least maximize our exposure to chapter 12. Realistically, chapter 12 on the exam is going to be attached to a chapter 5 question. So next Tuesday, when we do our chapter 5 questions, I'm not crazy. So we're going to do chapter 5, but also I'm going to make it like if it was the exam. And on the exam, they put chapter 5 questions with a little bit of chapter 12 questions, because we're looking at financial statements and such. So you'll have exposure. So that's what matters. Anyways, let's get it going. So fixed asset turnover. Fixed asset turnover. We're looking at a profitability perspective. No, not even actually. Let me see. Let me try to find it for y'all. Fixed asset turnover ratio. There you go. Yeah, it's a profitability ratio. Profitability ratio is literally, as the name says, is trying to assess to what extent is the firm doing in terms of its income, like how is their ability to actually earn income. So that said, let's try to figure out what that actually looks like. What does a profitability ratio actually looks like? So fixed asset turnover, based on the stuff we looked at before, what will be at our denominator? What will be our denominator? There you go. I think we understand the trick by now. So yeah, so average fixed assets will be on our denominator. What would be on our numerator? That one's a little bit harder in terms of just creating that link, because fixed asset turnovers don't really have a fixed asset doesn't have a specific thing that is attached to other than depreciation or amortization. Now, it would make no sense for us to assess amortization or depreciation, because we're looking at a profitability ratio, and it won't tell us much. It'll just tell us like, hey, here's to what extent this PPE is being appreciated. So to make it simple for you, this will be the only formula at which you need to remember what will be at the numerator. And in this case, it'll be our net sales revenue. Okay, our net sales revenue. So this is how a formula would typically look like. You're trying to assess your net sales revenue over your average fixed assets. So essentially, what you're trying to look at here is when a company, okay, you know what, really quickly, like in the chat, what are fixed assets that a company will generally have? Quickly, it takes 2 seconds to like write this one down. What is a typical fixed asset that a company has? What is a typical one? Like, for example, is a car an example, or is a building an example? Is land an example? What do y'all think? Land. Okay, cool. Boom. So a fixed asset looks like chapter 8, right? It looks at land, property, plant, equipment, anything that is either tangible or intangible that will last more than a year. Now, if you remember, the reason why a company will purchase fixed assets, non-current assets, long-term assets, is because these assets will help them generate revenues in the future. In other words, these fixed assets will help them in their process of creating and earning revenue. So with that in mind, it kind of does make sense to assess, well, to what extent are our fixed assets creating sales revenue for the company, right? Because there would be no other way or no other reason for a company to purchase these fixed assets. Let me give you another quick example. All of us probably have laptops or computers, right? And they're probably even Apple computers, right? The reason why we decide to purchase these laptops and computers is because they are crucial to our long-lasting success at school, right? If we don't have a laptop, we cannot take notes at school, we cannot work at school, and we probably can't work at home. So they are crucial to our long-lasting benefit. Same thing with fixed assets. So now we're just trying to see, well, our fixed assets are trying to do what? In our case, it was to earn grades. Well, then it's to earn money. So we're going to compare money to our fixed assets. So our net sales revenue over our average fixed asset. And the definition here is pretty interesting because we're trying to measure, okay, the company's ability to generate revenue, i.e. sales revenue, from its non-current assets. Why does this matter? What is the implication here? The implication is as follows. Let me just do something real quick. Why does this matter for us? This matters because the implication is as follows. A company would only, a firm purchases long-lasting assets in the hopes of generating revenues through it in the future. Okay, so that's the idea. So let me give you an example. We're going to go at the bottom here. Actually, yeah, we're going to go at the bottom. Let me give you a quick example. And I guess we could go here too. So let's say the company has sales revenues as revenue of $500,000 or $5 million, okay? But it has fixed assets. We'll put, it has building and property of so what I'd like to ask you, what would be our fixed asset turnover with the following inputs? What would be our fixed asset turnover here? If we know we have revenue of $5 million, i.e. net sales revenue, if you will, and we know we have building and property, that's all of our fixed assets, equal to $15 million. What would be our fixed asset turnover? What would be our fixed asset turnover? Nice. Very well done. Exactly. Okay, so this would be our fixed asset turnover. Now, this could say a few things. This could tell us that, hey, with these long-lasting assets that we have, it seems that we're not able to create a lot of revenues vis-a-vis the cost of these long-lasting assets. But let me give you another example. Let us say that our net sales revenue is equal to 50 million. Our fixed asset will be equal to 3.33. Does this mean that now we're able to do much more with our fixed assets? Yes or no? If our fixed asset turnover is bigger, right now it's $50 million. So it gave us a number of 3.33. Does that mean that the company is able to do more with its fixed assets? Yes or no? Exactly. Perfect. Thank you, Alexandra. Yeah, 100%. So really, as with all the different ratios that we had, do we want our fixed asset turnover to be bigger or smaller? What is a good sign that our fixed asset turnover is higher or smaller? There you go. Indicates that the firm has the ability to be more effective with its investments in fixed assets to generate revenues. This is really like fundamental. The idea why companies invest in fixed assets because they want to be able to generate revenues, such that we need to compare the two. Okay. So now we can move to another really classic one. All right. Now, what I'd like to share is kind of similar to what we said in the past, right? I think we could all notice that a lot of our ratios had an average in the denominator. A lot of these different ratios had an average in our denominator. And we said that if we see turnover in the ratio's name, we need to assess that whatever's at the bottom has to be the average of that title. But what's really cool for us is that we're able to use a similar perspective with our return on equity and our return on assets. We'll actually be able to apply the same idea. So because we have this word return in our ratio, it means that in our denominator, we're going to take the average of whatever return we're looking at. That said, can somebody tell me what will be the denominator of our return on equity? What will be the denominator of our return on equity formula? If you'd have to use the same perspectives that we've applied before, right? When we looked at inventory turnover, we took average inventory. I'm telling you that we could do the same thing with return on equity. So what would be nice? Okay, you guys killed it. Average shareholder equity. Amazing. So this is really cool because average shareholders equity is exactly what we're going to have at our bottom. So already there, if I ask you, well, what are we going to put here on our returns on assets formula? What will be on our denominator? Average what? What will be in our denominator for our return on assets formula? Just to make sure that we understand the perspective, what will be on our denominator for our returns on assets formula? What would it be? Okay, thank you. Nice. Average total assets. Okay, cool. So now we remember this and we know this. We know it's the rule. We know we'll never not do that. Great stuff. Okay. Now what I'd like to share is, okay, how do we decide what's going to be our numerator? Well, in this case, what's really cool, and this is something that you'll see much more as you progress at JMSB, but what's a very, very important thing here is that we're trying to see with this idea of return on equity, we're trying to assess to what extent is your equity creating a return for you versus the total set of your shareholders' equity. In other words, we can only look at a specific set of things. And the point at which we see the most of the accounts that are dealing with shareholders' equity is within our statement of earnings. And the absolute account or the absolute line within the statement of earnings is our net income. So what I'd like to say is that at the top of this formula, we're going to have our net income or earnings. Same thing, really. So our net income over our average shareholders' equity. Okay. So this is really important. We have our net income over our average shareholders' equity. So this is pretty interesting. Now, what I'd like you to understand here is that maybe we could look at it like this. We'll go at the bottom. Yeah, we'll go here. Okay. Let me give you all an example for this to make sense. Let's say that you just started a business. Okay. You created this iOS app. Okay. But you want to bring this iOS app throughout the world. Okay. You want everybody in the world to use it. You want kids in Africa to use it. You want kids in Morocco, Canada, etc. to use it. Okay. But in order for you to do so, you need an investment. So you go on Shark Tank. You go see Kevin O'Leary, Mark Cuban, etc., and you ask them for $100,000 for 20% of your company. Okay. And you know what? Mark Cuban says yes. So Mark Cuban gives you $100,000, okay, for 20% of your company. Okay. So he gives you that much for your company, such that you now have this much in contributed capital, which is something that you would credit, right? You guys remember. So this is how much you have in contributed capital. Now, if you guys remember, where does contributed capital goes? Like, is that a Is that something that goes in your statement of earnings? Is that something that goes in shareholders' equity? Is that something that goes in total assets? Where does contributed capital generally go? If you guys remember, where does contributed capital generally go? Exactly, it goes into shareholders' equity, right? Because this literally deals with equity. If you guys remember what equity is a form of financing raised through a stake in your company. So there are two ways of raising funds. There's two ways of financing a company. It's either through debt or through equity. If you raise money through debt, is that you're getting cash in exchange for a future obligation, i.e. a future notes payable. Whereas with equity, you're getting cash in exchange for a portion of your company, okay? That's why it's really important. You're getting cash for a portion of your company. So what return on equity really tries to look at is trying to see, well, within the people that have a portion of your company, how much earnings are they getting, right? Remember this idea of Apple that we had right here and earnings per share? Well, we're trying to evaluate how much money are they getting on average, right, over the total equity. Okay, so let me give you an example. Let us create a little scenario. Let's say we're looking at our new startup. Okay. So it's us five. There's Ismael, there's Daniela, there's Leandra, there's Alexandra, and there's Hussein. We all invested in this company. Okay. We all invested in this company. I put in 500K. Daniela puts in 100 grand. Leandra put in 900K. 9 million, no, 900K. Alexandra put in 75,000, and then Hussein put in 150,000. Okay, so what is the total amount of contributed capital that we get? What is the total amount of contributed capital here? Can somebody tell me? What is the total amount of contributed capital? What is the total amount of contributed capital? What is the total amount of money? Nice. This is a total amount of money, right? This is a total amount of money that was contributed within this company. Okay. But what's really interesting here is by definition, we could maybe try to find, if we zoom in, we could try to find, well, what is the percentage? How much equity do we all own in this company? So if we do this, divided by this, 4, we could see that I own 29%, and that Daniela owns 6%, and that Leandra owns 52%, and Alexandra owns 4%, and Hussein owns 9%. So we all know how much we owe, how much we have in this company. So far, we understand that. But what's really cool here is that, let's say that our startup made net earnings, right, in 2021. Our startup made, I don't know, for example, it made 400 grand. Oh, sorry, 400 grand. Okay. But we know that the total shareholders' equity of our company, because we don't have any common shares, it's a private company. So we know this is our total shareholders' equity. We know it's equal to 1.725 million, but we only made $400,000 this year. Can somebody tell me what would be our return on equity? This is how much equity we have in the firm, right? And our net earnings is equal to 400,000. What would be our return on equity? What would be our return on equity? Can somebody tell me? Nice. Okay, cool. So simple as this, right? What I would like for you to remember is that obviously in this case, we're only looking at 1 year, but if we had 2 years, it would be obviously different because you take the average. One thing that I'd like to share, because I'm going over time on this question, is that what's cool here is that by definition, earnings owed to. if I have 28.99% in this company, I'm owed this much earnings, right? I'm owed this much earnings, okay? And this is a idea, let's zoom out a little bit, that can be applied to every single one of us. If I just do this. So now, if we do the sum of all these, you would see that the total earnings that are given to our company is 400 grand, so it makes sense. And we are all owed a different amount of money because we all have a different stake into the company. Obviously, Alexandra has the smallest, no problem, Hussein. All of us have different shares, so by definition, we have different amounts. But what's cool here is that what you can notice is that the return on equity will be the same for everybody, okay? The return on equity will be the same for everybody. It will be 0.23 for every single one of us. So this is really just a different way for you to really understand and never forget what return on equity is all about. So it's net income over the average shareholder's equity. And why this is important and why I took the time to look at that is because you want to know, for every dollar that you invest in this company, how much money are you getting back? And now it makes sense for us to look at this distribution, right? I, Ismael, right, myself, invested 500K. And I know I'm only getting 115K this year back. So it means that my return on equity is 23%. And that return on equity is shared by every single one of us. That's why this definition is important, because we want to know, measures how much income was earned for every dollar invested in the company. So in this case, with a return on equity of 0.23, so 23 cents, it means that we make 23 cents for every dollar we invested in this company. All right, that's the idea. So the implication here is that, obviously, would you rather a higher return on equity or a smaller return on equity? What would you rather, a higher or smaller return on equity? If we go back to our example, yeah, for sure you would want a higher one, right? Because let's say, for example, we only made 40K, then it means that our return on equity is only equal to 2%, right? It means that we're literally making terrible money. We made a very bad investment, okay? So higher return on equity, the better for investors and the more efficient the company is in pooling its equity base. In terms of implications, I don't think there's like any outlandish implications here, other than it's a relationship of dollars invested to dollars made. Okay, so average total assets, I'm trying to get quicker, but average total assets, really essentially what you want to look at is not something that's super duper. Okay, so what's interesting here is that typically assets, right, such as land, equipment, etc., are very valuable things. They're expensive things. And when things are very expensive, sometimes the company needs to raise debt. It needs to use a loan, right? If we buy a home's very expensive, especially in Quebec. So you'll have to get a mortgage for you to be able to pay off the house and pay the sellers, right? So that's why when we look at assets, it's not always the best to look at profit. Okay, it's not always the best to look at just your net earnings, because you need to also understand, well, what is the tax break that the company is earning on taking on debt? It's a weird one, but you have essentially what we call a tax break for taking on debt. Now, this is a lot of stuff that we could try to look at, but I don't want to spend 20 minutes on it. So what I want you to understand here is that there's only a small difference between return on equity and return on assets. Return on equity has net income over shareholders' equity, Well, our numerator for returns on asset will be almost the same thing. The only thing that you want to have is net income plus interest expense. Okay. So do we understand that the numerator for return on equity and return on assets are almost the same? You just need to add interest expense. Is that okay? Okay, amazing. On the term sheet, they'll say net of tax, but honestly, that one's kind of like iffy. So I would say use this formula and you should be fine. Okay. And this one goes back to what we said about our fixed asset turnover. We want to be able to measure to what extent is a company able to generate profits from its total assets. Okay. So it's really as simple as that. You want to measure how much income the company generates from its assets other than the financing of those assets. The reason why I'm saying that is because we're trying to essentially just add the financing back for interest expense, but you don't need to worry about that too much. Okay, so by definition, I think this is fairly similar to the previous one. We would obviously want a higher ROA. We would want a higher ROA because this indicates company, as this indicates that the company is making more with its investments. I am trying to go a little bit quicker because I want to look at an example, but 2 questions. Was the speed okay for this? And 2, was this clear? Because if it's not clear, I will go back to our other perspective. So did this make sense? And was this clear? Okay, cool. Thank you. I appreciate that. Amazing. So the profit margin is super, super easy to do. It's actually one of the easiest ones out there. All that you have to do is you need to look at net earnings. You need to divide that by your net sales revenue. In other words, what you need to do, if we look at an example, is you need to look at your net sales revenue, which is this one, and divide it by whatever you'll have as, well, actually, you're going to take your net profit and you're going to divide it by your net sales revenue. So typically here, you'll have like a net sales revenue at the bottom of your income statement, and you're just going to divide it by your net sales revenue. It's really as easy as that. It's not any harder. Essentially, what you're trying to see here is that you're trying to see for each dollar of sales that you make, how much profits do you make? So measures how much profits the company generates for each sales dollar it makes. So in maybe a cleaner way, what they say here is that the profit margin measures the percentage of each dollar of sales that results in net income. So these 2 definitions are fairly good. Okay. Now, let me tell you this. Would you rather have a higher profit margin or would you rather have a smaller profit margin? It's an interesting question. Would you rather have a higher profit margin or a lower profit margin? What would you rather have? Alexandra says higher. Daniela says higher. Nice. Okay, really good stuff. A higher profit margin indicates that a firm is effective in turning its sales into profits. Now, I want you to remember this because you may need to explain a few things right on your exam. What I want you to say here is that a company could be able to make a lot of sales, so have a lot of revenues, but it may cost them a lot of money to actually create those sales. So for example, let's say for me, with ISMA Helps, let's say that I made, call it random number, $1,000 in revenues, okay? But for me to get students and to get people to come in, I have to advertise $10,000 every month. So obviously this shows that I have a negative profit margin because it's costing me a lot of money to be able to generate revenues. So I'm not able to turn my sales into profits. But for example, let's say that I was making $1,000, right? But it cost me only $1 to get some clients in, then this means that I'm extremely efficient into turning my sales into profits. So this is just a different way to understand why the profit margin is relevant. Okay. Before we go, clear, easy, makes sense? Amazing. Cool stuff, cool stuff. Okay. So earnings per share, we already covered. Do we remember what earnings per share is, right? We literally just did it before. Okay, cool. I won't spend too much time on that. It's really easy. It's measures return on investment the company is making. It's really easy. Higher EPS signals higher signs of earnings for the firm. Really as easy as that. Okay. So now we get to look at solvency ratios. So does anybody here know what it means to be solvent? Do you know what that means to be solvent? What does that mean? What does it mean to be solvent? Anybody has an idea? Okay, I like that definition, yeah. And essentially, being solvent is the ability for a firm to live in the long run. And what does it mean for a firm in the real world to live in the long run? It's for them to be able to pay its creditors. And for them to be able to pay their creditors, they need cash. So typically, that's how we really try to assess this idea of solvency. So living in the long run. So you look at three things: their ability to live in the long run, their ability to pay off their long-term debts, and their ability to generate cash in order for them to be able to pay off their long-term debt. And if they're able to pay off their long-term debt, then they'll be able to live in the long run. So it's kind of like a top-down and bottom-up approach type of thing. So the first thing that we need to look at is this idea of times interest earned. And this one's a little bit interesting, and that's why I want to start with a definition first. So this ratio measures how many times a company could pay the interest with its before tax income. Okay, so we're trying to understand how many times a company could pay interest with its before tax income. So this is interesting, the before tax income. Now, I would like to allocate a few ideas here. Two things. The reason why we're looking at before tax income is because whatever the company has before tax must pay its creditors. So what I'd like to say is two things. In life, creditors, so whoever you owe money to, will always get money before taxes. They are owed this, that's why they make this decision. That's why they decide to invest in you. So creditors will always get money before taxes. Really important thing to remember. And that's why we're looking at before tax income. Because no matter what, whatever money you had, right, before your income tax was going to be given to those creditors already. Do we understand that idea? Does that make sense? Okay, cool. Like that's just the way it is. Once again, just to visualize it, literally everything before income, before tax, you'll pay your interest before that, right? You see how we have this? We're paying interest before. So, you know, just a visual. So yeah, that's why we're looking at this idea. So in order for us to be able to allocate this perspective, is we're really just trying to assess, well, all the money that we have, right? Before our income tax expense, before our interest expense will be the money we're able to allocate to our interest expense. Let me give you an example, it'll be better. So let's say we had net earnings 100,000, This one is important because I doubt that she'll be able to remember this one. Even me, I don't remember it. So I'm trying to like visualize it with actual examples. If I just talk, I don't think it'll be irrelevant. So we have interest expense and we have income tax expense. These are the only things that we need to understand. And we'll say that this one's the fixed income tax expense of $45,000. And okay. So let's say we had a loan of $450,000 and the interest rate was, call it 0.6%. Okay, so if this is our loan and we have an interest rate of 6%, so we need to pay 6% interest every year, can somebody tell me what would be our interest expense? Just for fun. So you're just gonna multiply these two together. What would be our interest expense? Nice. Okay, cool. Okay, so we have these three values. I think we could all agree that our net earnings is at the bottom. So we have 100,000. Actually, I could just put this here. I think we could all agree that we have our net earnings at the bottom. So we have 100 grand. And then we would have our income tax expense. Then we would have this here at 45, and we would have just wait, you'll see why this makes sense in 2 seconds. Okay. So obviously, our net earnings has already absorbed our interest expense and has already absorbed our income tax expense, right? So if we're trying to see how many times we're able to pay our interest expense with our net earnings, that wouldn't be representative, right? Because we took two factors that we're gonna allocate to our interest expense no matter what. Do we see what I'm trying to say here? That we cannot take net earnings because our net earnings already absorbed the cost of our interest expense and it already absorbed the cost of our income tax expense, right? Because our earnings before interest and taxes would be equal to, essentially, this much, right? This is how much we had before. This is how much we had before we had to pay anything regarding interest expense and income tax expense. So if we took net earnings as our value in our numerator, we would be making an error because that would not be allocated to our interest expense. Do we understand that? Does that make sense? I'm trying to see if that makes sense. Okay, cool. So, and for that reason, when we make our formula, we need to look at our earnings before interest and income tax expense, okay? Because we want to see how much could that money that would be allocated for sure at our interest expense will cover our interest expense, right? Because our earnings before interest and taxes, so our EBIT, will then be allocated to our interest expense. And then whatever is left will be allocated to our income tax expense. And that will give us our net earnings. And that is why we need to look at this number, okay? I'm sorry if that wasn't so clear. And for that reason, what we do is we do this. We do net earnings plus interest expense plus income tax expense over our interest expense. All right? That's why our formula looks like this. So that said, could somebody tell me what would be our times interest earned? What would be our ratio here? What would be the answer if we know these different things? Nice. Okay. Exactly. Does everybody understand why we got to 6.37? Do we get that? Is that clear? I know this one is it's kind of a boring class because it's not very it's not high action. It's just remembering things, but it's really good. This is probably the hardest one you'll need to remember. So this essentially tells us that we're able to cover our interest expenses many more times. Okay. So obviously, by the way, if our interest expense was call it 90K or call it even 124,000, this would mean that we're covering our interest expense much less. So we need to be careful. Okay. So it's important things to remember. Really, what I'd like to say here is that we get interest expense when we have debt, and we're obligated to pay interest expense. There's no other way to go about it. A company has to pay their creditors. So for that reason, we would appreciate larger ratios. Larger ratios are considered more favorable because they signal that the firm can pay its creditors with the cash it has. Does that make sense? Are we okay with this one? Nice. Good stuff. Okay, cool. Okay, so debt to equity ratio. Can somebody tell me what the formula is for a debt to equity ratio? What would that be if you'd have to guess? What is our debt to equity ratio if you'd have to guess? What is debt and what is equity? What represents debt and what represents equity? What about Leandro and Alexandra? What do y'all think? What represents debt and equity? What represents debt and equity? Is Daniela right? It's a good question. What she said, exactly. Good stuff, amazing, yeah. So debt means liabilities, right? Equity means shareholders' equity. And I even put it in order for you, okay? So all that you have to do total liabilities over total shareholders' equity, all right? It's as simple as that, okay? It's as simple as that. Now, one thing that I'd like to share here, and this is something that you'll see a little bit more in the future, and the more debt that a company has over the amount of equity it has is kind of dangerous at times. So that's something to consider. Another thing that I'd like to say is that this is able to measure, this debt to equity ratio is able to measure, well, how is the pie divided? Okay, what piece of the pie is dedicated to debt and what piece of the pie is dedicated to equity? This is exactly what this formula measures. Okay, so in other words, this indicates the percentage of financing that comes from creditors and or investors. Okay, so more debt is risky for a company is a very important implication. And then in the interpretation here is fairly simple. This formula and on the exam, what should be required to answer is the following. So the higher the debt to equity ratio means that, for example, that more financing is coming from creditors, so loans and banks, than from equity investors, so shareholders. A smaller debt to equity ratio means that more financing is coming from equity, so equity investors, i.e. shareholders, than from banks or loans, okay? So higher DE indicates that more financing is coming from creditors, example, banks, than from investors, i.e., or example, shareholders, and vice versa. This is honestly as far as you need to go with this specific formula. So is this clear? Does this make sense? Nice. Okay, cool. Okay, so this is the final one. This one is something that you'll see in chapter 5 as well. And it's something that we call our cash coverage ratio. Okay, and it's very similar to all the other ones. And this ratio measures how easily a firm can pay off its debt, can pay off its interest on debts that it has with cash from operating activities. It's really simple. All that you have to do is you need to assess your cash flows from operating activities over the interest paid by the company. Now, this one is something we'll look at a little bit more in chapter 5 because we're going to make better sense of what a statement of cash flows looks like. Now, the cash flows from operating activities essentially is similar to the cash you make through your current assets and current business. So within this specific period of time. And then you're just going to compare it to the interest paid by the company. In other words, the interest expense paid by the company. Because one thing that I'd like to share is net earnings aren't always representative of how much cash the company actually has or has actually made within that period. Net earnings also has also priced in non-cash expenses. Can somebody tell me in the chat what are non-cash expenses, or just give me an example? What is an example of a non-cash expense? What is an example of a non-cash expense? Okay, so by the way, a non-cash expense is something that will be on your statement of earnings. Okay, so Alexandra brought up depreciation. That's an amazing one. Do we have another one? Alexandra, we actually looked at one together in our last session, if you remember. What's a non-cash expense? Something that we use to balance a specific type of transaction or journal entry. That we looked at chapter 5 as well in operating activities. Anybody else also could share their ideas. What is a specific type of non-cash expense we looked at? Nice, Leandra. Yes. Okay, so amortization is also very good. And then the final one that we will typically look at is this idea of this gain or loss on disposal or sale. It's not very much a cash expense. So that's why we need to look at the cash flows from operating activities. Very good. I like the fact that we're using our brains right now and we're working hard. Good stuff. So this one's simple, right? The answer here, the interpretation is that we want to assess whether the company makes enough cash to pay off its interest paid. It's really as simple as that. Okay, it's as simple as that. Okay, so we've built a table together. Obviously, this table is made to kind of like demonstrate the notes that I would want you to have here, you know, like how to make sense of these different questions. So overall, how do we feel about these different explanations? Do we feel better off now than before? Do you have a better sense of these formulas? Yes or no? Okay, a lot better. That's cool. Okay, that's good news. At least we have that. Okay, sounds good. So now, okay, now we understand the formulas, we understand what's the definition, and we understand the interpretation. So we're going to take a 3-minute break because I just want to go drink some water to talk more. And then we're going to do one problem. Okay. Okay, no problem. So we're going to have another like 20 minutes or so through the recording. And let me just go take a 3-minute break. We're going to come back into it and we're going to do problem 1. So in the meantime, what I could say is perhaps you could look at the problem, and I'll also share this document, I think. I'll share this document as well. This will be, give me a sec. I'll share this document in the chat so you could start doing it in the 3 minutes. Actually, no, you know what? Let's take a 3-minute break and then we'll start it together. Okay, so let's take a 3-minute break. Let's give it a shot in 3 minutes. All right. Are you ready? Are we excited? Are we stoked? Nice. Okay. Quick question. Are we able to read the text like proper? Like, is it fine? I think it should be fine. Okay. Okay, yeah, I'll try to zoom in a little bit. Sorry about that. Okay, cool. So let's try to go through it. We'll kind of go fast because it's easier stuff, right? So Golden Ink has the following comparative income statements and balance sheets for 2021, 2020, and 2019. Please see the below for statements. Compute the following ratios for 2021 and 2020. So here we have 7 ratios to look at. The cash ratio, the current ratio, the average collection period, the fixed asset turnover ratio, the financial leverage ratio, the return on equity, and the dividend yield. A lot of things. And we got to do it for both years, 2021 and 2020. So what I'm going to do is you guys are going to tell me what we need to do for each, and I'm going to create this little table in which we're going to have all of our answers. So we're going to have our answers. So yeah, we're going to have 2021 and 2000. Just going to okay. So let's go to it. So for the first one, the cash ratio, let me give you the info. Okay, well, what do we need to look at for the cash ratio? I think that's the first thing to check out. What is the definition? What is the formula? What is the formula for the cash ratio, if you remember? All right. What is the formula for a cash ratio? Do y'all remember? Oh, kind of help you guys at the same time. Okay, so we're looking for the cash ratio, by the way, not the cash coverage ratio. So the cash ratio. So yeah, Daniela, nice, exactly. So the cash ratio. What I'll do is, because I'm lazy, I'm just gonna go copy it. I don't even think I have it actually. So yeah, the cash ratio essentially will be equal to cash plus cash equivalents divided by current liabilities. Okay. So that said, we have that. So what I'd like you to do is, let me maybe share this document with you actually, because I want you to do it at the same time with me. Like that could be annoying and tell you, hey, what is the answer? So the code book one. I just sent it to y'all. I'll put it in the chat right now, so you guys will be able to have access to like the financial statements. Okay, so I put it in the chat. Now I'm going to ask you, can you please find the answer for 2020, 2021 and 2020 for the cash ratio? Okay, it's in the chat. It's in Excel, and if you go to problem 1, you'll have everything that you need. You'll have your cash and cash equivalents. You'll have all that good stuff. So for 2020, how do we go about this? So we need our cash and cash equivalents that we have, and we need our current liabilities. I think we have that as well. Yeah, sure. Amazing. Okay, so cash and cash equivalents are literally things that can be literally turned into cash immediately. What's really interesting here is that cash and cash equivalents don't necessarily have to be in your statement of financial position. It may be that the company does not have any cash and cash equivalents. But in this case, by the way, cash equivalents could also be considered short-term investments. Okay, so short-term investments could be considered what we call cash equivalents. So just to help you guys, we'll have cash and short-term investments, and then we'll have accounts payable and short-term notes payable. So I would like you to calculate the ratios for both years. What would that be? 2021, you have 145,000 plus 30,000. And we need to divide that by our current liabilities, which is 505,000 plus 210,000. And yes, we do get to the same amount, Daniela. Okay, so Alexandra, you need to find for 2020. All right, you need to find for 2020. What did you get? What did you get? Yes, amazing. That's exactly it. Good stuff. We're on a roll. All right, cool. Now let's look at the current ratio. What is the current ratio? This one we spent some time on. I know you know. What is the current ratio? We literally talked about it so much. There you go. Exactly. Just actually. Okay, good stuff. Amazing stuff. So with that said, we need to look at our current assets over our current liabilities. So I need you all to tell me what will be our current ratio. What will that look like? What are we looking at? Kind of giving y'all some tips. What would it be for 2021? Nice. Okay, and then Alexandra, what is it for 2020? Okay, so you're dope. You're dope. Okay, this is how we're gonna do it for the rest of like the session. Is Daniela, you're gonna do 2021. Alexandra will do 2020. I love it. Nice. Okay, cool. We're doing really well. So now the average collection period. Do you remember how we have to do this? How did we do that before? Is it one step or two steps that we need to do? Two steps, exactly. So we need to find first and foremost our what's it called? So our trade receivables turnover, okay? And then once we have that number, we're gonna be able to find our average collection period, okay? So you're gonna do 365 divided by our average and this could be written in a bunch of different ways, even just write net credit sales by so don't forget that is average trade receivables, okay? Average trade receivables. So I think there's just one small error. Alexander, there might be one small error. So please don't forget that you need to do net credit sales for that specific year divided by the average trade receivables. So the average trade receivables will, if I put everything back to not bold, will be for 2019 and 2020, right? You'll have to look at these two. And then in the other case, we're gonna have to look at these two. This will be your net sales values. So Daniela, you say it's 12.34 for year one. Let me see. Is that accurate? It's not the correct answer. It's not the correct answer. Okay. Alexandra, did you retry for 2020? Just to see if you have a different answer? And if not, we're gonna look at it together and you'll see what this is all about. You'll see maybe we'll be able to identify where perhaps there was a mistake. Okay. So first thing first, we're going to identify net credit sales. We're going to identify trade receivables year one, trade receivables two. Then we'll have our average. Okay. So what is our net credit sales for 2021 and 2020? Could y'all write that in the chat? You know what? I'll just write them down and you'll tell me if it makes sense. Yeah. Perfect. Okay. And then by definition, this one will also be this one. Okay. Can we agree that this is correct? Yeah. Perfect. Amazing. So trade receivables for year one, when we're looking at 2021, what I mean is essentially this one, 570. And for 2020, the first trade receivables that we're going to look at will be for that same year, 425,000. Is that okay? I would like to think so. Okay. And then for the year two, essentially, you're always looking at a year backwards. So here we have 425,000. And then for 2020, you're going to be looking at year two as 2019, the year right before. Yeah, there you go. Exactly. And then what you can do for the average is you just add these two up. Then you're going to divide it by 2. And we're going to do the same thing for both. Right? And then when we want our ratio, all you have to do is you have to take your net credit sales divided by this, and then your net credit sales divided by this. And then you could find your second ratio, your two-step ratio, which is your average collection period, is going to be equal to 365, sorry, divided by this, and then same thing. So is that clear now? Do we understand? Daniela as well? Do you feel the vibes? Nice. Okay. If you don't mind me asking, Daniela, what was the mistake?
The thing is, I did exactly what you did. So I don't know. I probably like did something wrong with the calculator.
Yeah, probably. That makes total sense. I think when it's a two-step one, I really think what I used to do is I had my paper and I would just write one by one every single step, because they allocate 35 minutes or something like that to this question. Might as well take the time, right? So definitely help. Okay, cool. We may go over time by like 5-6 minutes. Is that okay? I just want to finish this question at least. Perfect. Okay, cool. So we have that. Put these as numbers. Okay, so we have that. That's amazing stuff. Super stoked. Super stoked. Okay, so now we're looking at our fixed asset turnover ratio. Okay, can somebody tell me what is that fixed asset turnover ratio's formula, if you guys remember? Nice. Divided by our average fixed assets. Okay, so same thing, same division of tasks. Daniela 2020 and Alexandra 2020 Alexandra 2021 Daniela, and we're gonna go for it. Yeah, exactly. Exactly. Those are our fixed assets. So net sales, net credit sales, same thing. Net sales and net credit sales are the same thing. So nice, Alexandra, good stuff. So that one is correct. Now, Daniela, net sales revenue. So that's fixed. That's like a specific amount that we already know. And then for our average fixed assets. Oh, what was the mistake, if you don't mind me asking? Gotcha.
I took the wrong number from the table. Yeah.
Exactly. Honestly, this happens even to me. So I'm like, I'm so unsurprised. It's like something common. Like this chapter is such an easy place to get points, and it's such an easy place for us to lose points at the same time.
Right.
But what's cool is that it's written, so you'll be able to like show your work, right? Just show them that you've identified what's up, and you'll be fine. So now let's look at this financial leverage ratio. To be fair with you, I do not think that this is something that we see quite often, to be honest with you. But we'll spend the time on it. Why not? So essentially, for the financial leverage ratio is a two-step ratio. It's very rare to see, but essentially what you need to do is you need to take your return on equity minus your return on assets. Okay, you need to take your return on equity minus your return on asset. So returns on equity minus return on asset. So I would like you to tell me what is the return on equity formula and what is the return on assets formula. So what is the return on equity formula? Somebody tell me in the chat. Nice. Okay. Nice. And then what about the second one? Sorry. Nice. That's killing it. Exactly. And I'll just write this for space. Okay, cool. Okay, amazing stuff. So what I'll ask you is, Daniela, you could do net return on equity, and Alexandra, you'll do return on assets. And we'll kind of like segment those two. And then once we have those, we'll do the 2021, 2020 split as per usual. All right. So net earnings. You have your Excel, so I'm going to pause my screen to do my calculations. Actually, no, I'll let you find the answers and then we'll do it. So right now I need return on equity for 2021 and 2020, and then return on assets for 2021 and 2020. Each of y'all have one to do, and then from there we'll move towards the financial leverage ratio. Nice. Just peeping something right now. Okay, so I have 2.06. Oh.
I have a question.
Yeah. What's up?
For the average shareholder equity, do I like add the common shares to retain earnings and subtract like the year after?
You could literally, that's a really good question. For this sake, I would just add these two together. That's it.
Oh,
Draw.
but at this average, I also do it for like the 2020. No, yeah,
Yeah,
2020.
exactly. You do like the sum of these two plus the sum of these two divided by 2 would give you the average, and then so forth. But what I'd like to share here, I think they made a mistake in their answer. So I think we're actually gonna have to skip this one. That's why this one's in common, because they just took the average return on they took the average assets divided by the average return on by the average shareholders equity, and that gave them their answer. I don't think that's accurate. So I think we're gonna have to skip this step just because what they did in the solution isn't definitely what you should do. Because the financial leverage ratio, something you'll see in your future finance classes, it's return on equity minus return on assets. So kind of bizarre. Alexandra, you got for your return on assets, you got 2.06 for what year? 2021. Yeah, no, I think we're gonna have to skip this still, just because it's not very representative of the actual formula. So I would say, never mind. Let me just see. Okay, what I'll ask instead, we'll skip the financial leverage ratio, but I'm still gonna probe you on this one. So I'm gonna ask you the return on equity. So Alexandra, you found the one for 2021. Okay. I'll ask Daniela, can you find a return on equity for 2020? Find a return on equity for 2020. And Alexandra, I'm gonna tell you that I think you have a mistake. So it's worth maybe retrying to find net earnings and divided by average shareholders equity for 2021. Oh, okay. Guys, we're gonna do return on equity for this one. Just because there was an error in the previous one for financial leverage. So for this one, it's wrong. Their solution bank, so it's not worth it. So we're gonna do this one, compute return on equity. All right. So compute return on equity, Daniela 2021, Alexandra 2020, like we did in the past, and we'll get through that.
Wait, Amos, what do we have to find?
Okay. Show you already here. This is gonna be Daniela.
Okay.
All right. Okay, so Daniela, you found 3.28 for your return on equity for 2021. Can you tell me what were your steps? Yeah, no, for sure, too tired is guaranteed. Like we've been grinding tonight. So I think what I'll do, just because I know after 3 hours it's almost impossible to concentrate. But what I'll tell you is this. So I put this here. Okay, cool. So net earnings, really quickly, for both years, all that you have to do is you have to take this income before income tax minus income tax expense. okay? And we're gonna do that for both years, and that gave us these two amounts. Then it's really simple, just the average shareholders' equity for both years once again, which is the sum of these two plus the sum of these two divided by 2, then the sum of these two plus the sum of these two divided by 2. That's going to give us these two numbers. All then what you have to do is just divide this by this by this. It's going to give us our return on equity. Okay. So then our dividend yield. Okay, our dividend yield. Okay, cool. Our dividend yield here, what I'll like to do is we remember this, it's dividend paid, if I'm not mistaken, dividend paid per share divided by market price. And this one I'll do for y'all. Okay, so in this question, we need to figure out how are we going to get our dividend paid? How are we going to figure that out? How did this company actually make dividends here? And this one's pretty interesting. So we just got to figure it out really quick. I think there's things I did not add in the question. Let's see. So let me see. Just trying to peep something. I'm trying to see if I added something in a prompt that I did not put. So give me a sec. I'm trying to find something here. I'm trying. Let me see. Interesting. There's something that seems to be wrong in the solution bank still. So interesting. Okay. Well, this I'll put into solutions because I think there's two things that we're missing here. I think we're missing two elements for this question, which is number 5, we're missing some buckets, and then number 7, we're missing some key pieces in the solution bank that I need to review. So on that end, we're gonna have, when I send you the solutions, I'll just have to add that. But before we depart, because I know our brain cells are probably fried by now. What I'd like to say here, though, if I go back, let me just pause my share and open a doc really quickly, because I know we're for sure tired by now. Yeah. Okay, so really quickly, can you let me know, have you seen this document? Have you taken a chance to read it? Have you taken a chance to look at it? It has more notes on everything chapter 10. It gives you a little bit more context on the things we've discussed in the previous class. And it also, exactly, so I'm gonna put it back into the chat because I shared it and I don't know if people saw it, but this document is essentially a course pack just for chapter 10. And it has every single thing that we've discussed in the 3-hour lecture put into a condensed and like maybe even furthered a little bit. It's essentially what I do is after each one of our sessions, I create a course pack. Sorry, resume share. You should be able to see my screen. This one, have you seen this document? That's what I'm trying to say. Sorry, my thing was frozen. Yeah, exactly. So it has all of the different things that we've discussed, and it literally tells you what journal entry to do. Like it's as easy as it gets as you review chapter 10. And what I'd like to say is that I'm going to put the same one, but for chapter 5 tomorrow by like 8 or 10 p.m., something like that. I usually post it 24 hours after a session. And this would give you a lot of different feels for what we discussed today. So don't worry if there are things that you feel like we need to look at more in detail. We're also going to have all the solutions for everything. So it'll be pretty cool. But yeah, so 3 hours and 15 minutes later, I hope this was helpful. I hope it gave a little bit of a feel, and the recording will be posted as per usual. And yeah, it was a good time. No problem, no problem. All right, so I'll put this stuff in the chat. Don't hesitate to send me a message. I'm sure you all have already done that, and we'll get it going on Tuesday.
Thank you so much.
No problem. Bye
Bye.
bye. Good night.